Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We have back on the show our commodities guru, Rick Rule. Rick, thank you for coming back on the show.
Steve, thank you for having me back. I enjoy these sessions.
I do as well, sir. Yeah, we've upped our game a little bit. We painted the background here, dressing for success, taking a page out of your book. Yeah, we're ready to rock.
Great. I've been taught that a necktie is evidence of the high esteem that you hold your audience in. So I think doing that for the benefit of your audience, but also doing it to instill in yourself a sense of importance is important. So congratulations.
Oh, thank you. Thank you. Okay, what I'm excited about, we have our upcoming royalty and streaming boot camp. And as a serial attendee, I can tell you that your boot camps, the uranium boot camp, silver boot camp, electric and battery metals boot camp, the information received pays for the $99 boot camp. I mean, just the uranium boot camp a year and a half ago, the one bet that I'm thinking of, Kazatomprom, simply the dividends from that one alone have paid for the boot camp over a dozen times. What can we expect from this next boot camp, the royalty and streaming boot camp?
Well, with my partner, Albert Liu, and I, investor education is important to us. We want to make money at it. Don't get me wrong. We want it to be sustainable. But we want to make the best product that we possibly can. We have learned that covering a discrete subject deeply, giving people the ability to understand that subject and give them enough knowledge that they become competent to do that work for themselves is our value proposition. As you suggest, at the Royalty and Streaming Bootcamp, we'll take a page out of the Uranium Bootcamp, and we'll begin with an overview of royalty and streaming. You'll remember in the Uranium Bootcamp, we had Per Jander, who's one of the world's ranking experts in uranium, give people an overview of the uranium market, which put the whole rest of the 8 hours in context. We're doing the same thing at the Royalty and Streaming Bootcamp with an old friend of mine, literally and figuratively, Doug Silver, who partially invented the mineral royalty business. He was responsible for the early success of Orion, which was and is one of the great private equity and royalty businesses in the minerals business. Our attempt is over 8 hours to make you a competent investor in royalty and streaming. And royalty and streaming is the best of the businesses in mining. Royalties, of course, are a financial interest in a deposit that gives you a piece of the revenue stream without exposing you to any of the costs. You don't have the capital cost, you don't have the sustaining cost, you don't have the operating cost, you don't have the labor cost. Your gross is your net, a very good business. The streaming business is a financial interest in the revenue associated with the deposit. Again, your costs are fixed. Wonderful businesses. Steve, as you've learned now being at our conference, at our boot camps, it's impossible to absorb all of the information that we give you in the 8 or 9 hours that we use to give it to you. The consequence of that is that the transcripts, the tapes are available for you for a full 12 months. I put on the uranium boot camp. I've been in the uranium business myself for 30 years, and I still needed to play the tapes 4 times. The most important part of the guarantee, Steve, is that yes, there's a $99 tuition. There's a gold-plated money-back guarantee. If you attend the Royalty and Streaming Bootcamp, you pay me the $99. If you don't think you got your $99 worth, email me and I'll send you the $99 back. We would like it if you told us how we failed you, how we could make the product better for you. But there's no requirement that you answer any questions. The only requirement is that you honestly believe that we didn't give you your money's worth. Now, I can tell you, in now 28 years of making that promise around educational products, we've had to refund about 1/10% of the tuitions charged. I am highly confident that this guarantee is just that, a guarantee. But it stands as my absolute commitment to people that if we haven't delivered value, we won't extract value from them.
Awesome. I look forward to it. The model of royalty and streaming is so brilliant because you can run a giant company with just a few employees. I mean, it's like the best of the best. Franco Nevada, I think the last I checked, their market cap was over 20 billion, and they had about the same number of employees. It was incredible.
Well, put differently, most big hedge funds are charging 150 basis point management fee. Franco Nevada runs, if my memory serves me well, on 11 basis points. The
Wow.
general and administrative expense for Franco Nevada is 11 basis points of revenue. That's insane.
Yeah.
It's truly insane. Another way to quantify it is that Franco Nevada was started around the Gold Strike royalty, acquired, if my memory serves me well, in 1982 for $2 million. That royalty has returned $1 billion to Franco Nevada shareholders. But not just that. The Franco Nevada management team is good enough that they have recycled that $1 billion into high internal rate of return reinvestments. Truly a wonderful machine.
Awesome. Well, we hope in your boot camp we find the next Franco Nevada. All right. Okay. Listener questions. We got off. Let's start a little bit of current events. We know you're not a geopolitical analyst, but as commodity investors, we need to be aware of what's going on macro in the world. Iva wants to know, what are your thoughts on the current situation in the Middle East and how that could affect some of our bets?
Well, certainly it's a tragedy, first of all, and I don't have any policy prescriptions. I think there's lots of sin on all sides. If the conflagration spreads, and I don't think it will, but if the political response around the conflagration is a greater resolve on the part of Islamic countries to punish non-Islamic countries through energy, then I think you could see widespread dislocation in debt and equity markets, and in particular, higher oil and gas prices. I don't think that will happen because I think that many of those Muslim countries were and probably are beneath the surface much closer to at least official sector rapprochement with Israel. But I wouldn't want to count on it. I, unlike many of your listeners, was around in the decade of the 70s, and I saw the impact of the Arab oil embargo on debt markets, on equity markets, on economic confidence, and in particular on oil prices, which went from $3 to $30 as a consequence of constrained supply. And I wouldn't rule anything out in a global economy that's as stretched as our global economy is today.
Okay. All right. So the commodity you see expected is oil.
Oil in particular, yeah.
Yeah. Okay.
But confidence too. War is not good for investor confidence.
Yeah. Yeah, no kidding. We saw that with GoVX and Global Atomic. Okay. Stella wants to know, would like to know what Rick's portfolio would look like and how it would change if a global war were to break out, or if we were to enter into a bad recession / depression. Where should one put their money so they don't lose it all?
I think that going into periods that have you afraid, that you need to maintain more liquidity than you otherwise would. And maintaining liquidity during an inflationary period is really painful. The idea that I, as an example, am maintaining high US dollar liquidity, mostly in short-term treasuries, paying me 5%, when the currency that I'm saving in is depreciating from my count at 7%, not the 3.4 suggested by the CPI, means that those savings are costing me 1.8% a year. I consider that 1.8% annualized loss as an option premium on having the liquidity available to take advantage of dislocations that might occur in a market in a panic. I remember heading into 2008 with a lot of liquidity, and I remember that 2009 was one of the best investment periods of my life because I had both the cash and the courage to take advantage of a circumstance where most of my competitors had neither. So to the extent that the questioner is nervous about global geopolitics or nervous about the impact of debt and deficits in his or her home country, I would tell them that the first line of defense is liquidity. For myself, liquidity includes precious metals. I consider gold and silver to be money, volatile money, but good money nonetheless. It's only money if, in a panic, you are willing to turn that gold or silver into an investment in another asset class that becomes depressed as a consequence of the financial panic. In other words, gold and silver are only liquidity if you think of them as liquidity. For me, they're good if volatile liquidity.
They're only liquid if you're willing to sell it.
Correct.
Okay. Wolfgang, our number one fan from Germany, and Lazar kind of have the same question. Basically, like exit strategy. So given a stock developed well, how do you decide the time to sell? And do you do it all at once, or is it kind of in tranches?
I don't think there's a one size fits all. What I try to do is periodically review the reasons that I own the stock. Let's say that I own, a development stage company. I might assume that the circumstance that adds value is the completion of the feasibility study and the attainment of the capital necessary to put the mine in production at reasonable terms. If the company's ability to do that becomes problematic, in other words, if I think they're going to be unsuccessful, I sell the stock. If they have been successful, I look at what the next value creation opportunity is. Maybe it's on time, on budget completion at nameplate capacity. I try to assess what the probability of that is, how much time it will take, and what the value of the company will be upon successful completion. If the price of the stock now is at a substantial enough discount to what I think the probable value of the company is 18 months from now or 2 years from now, at successful completion, I either hold it or buy more. If the stock is overvalued relative to the probabilistic value on successful completion, or if I think that successful completion is unlikely for various reasons, I'm likely to sell the stock. I realize that the questioner is looking for a one-size-fits-all answer that doesn't require him or her to do any work. Very much like we were all hoping for the tooth fairy when we were a kid. But absent our mother and father, of course, that tooth fairy didn't exist. So the truth is that the question itself requires consciousness and work.
Okay. Review your thesis and see if it still holds.
Correct.
Okay. Just kind of macro view, lithium and nickel. Where do you see these going in the next 18 to 24 months?
Lithium in the near term is, not in the near term, pardon me, lithium in the longer term is challenged by supply. There is lots of lithium in the world. The price is up by 400% in 5 or 6 years. Markets work, which is why you're seeing the softness in the lithium market now. We never had a shortage of lithium. We had a shortage of processing capacity. The demand for lithium grew so quickly that the ability of the big lithium producers like SQM and Albemarle to construct processing facilities that turn out lithium-based chemicals was found wanting. This debottlenecking has been occurring at a fantastic and frenetic pace for 5 years, at the same time that new sources of lithium have been found and are being brought into production. If you add on top of that the efforts that are being made by Exxon Mobil, Berkshire Hathaway, and others to extract lithium from saltwater brines attendant to geothermal production and oil and gas production, you have a circumstance where lithium is yesterday's story. And the expectation around lithium stocks has been built on their past performance, which is to say the expectation of investors for the future of lithium has been a function of their experience in the immediate past. Well, the future is changing. I think it's a very, very dangerous space. It reminds me of the uranium space in 2010 when uranium could do no harm, but did. Nickel is a different circumstance. In the very near term, the nickel price is going lower. because of the incredible investments that are made in laterite oxidized nickel horizons in the Philippines and Indonesia. Longer term, the environmental degradation that is caused by those deposits will mean that some mitigation will need to take place, which will raise the cost of producing that nickel. I'm a real bull on the nickel business in the 5-year time frame, and I'm a bear on the nickel business in the 12-month time frame. So investors need to ask themselves the question, which is to say, which time frame is optimal to them? I'm, as you may know, a very large shareholder in a nickel, platinum, palladium discovery in Brazil, a company called Centaurus Resources. This is not for the faint of heart. I'm always attracted to potential tier 1 deposits, deposits that I think could have $10 billion worth of in situ value of recoverable reserves and resources, irrespective of the commodity. I'm attracted to $10 billion worth of sand and gravel. So to me, the deposit itself is more important than the commodity.
Okay. All right. So lithium, you think, has kind of gotten ahead of itself, and expectations are.
And if somebody found a lithium deposit now that was in the lowest cost quartile for lithium deposits worldwide, in the best deposit, in the best quartile worldwide for return on capital employed, and had $10 billion in situ reserves and recoveries, irrespective of my outlook for lithium, I'd buy it if it was cheap enough.
Yeah. Okay. And nickel, sounds like you're pretty similar on that as your stance on copper in the next year or so.
Yep.
Bearish,
Yep.
next half a decade,
Exactly.
bullish. Okay.
Exactly.
All right. I've gotten some questions on your rankings. So if I'm not mistaken here, in the last 30 years, you've had less than a dozen number 1
That's correct.
rankings, right?
That's correct.
A number 2 ranking for you is no ongoing visible concerns. It's selling at a realizable 50% discount to net asset value. It's run by honest people with a big stake in their company. And it's in a commodity that you don't believe is in a cyclical high. Is that accurate?
That's correct. And the management team has to have significant experience in an activity related to the task at hand. In other words, if these guys were successful operating a gold mine and what they're doing is exploring for copper, that's not the same as a successful management team.
Okay. All right. Yeah, if they're looking for gold, we don't care if they found coal. Okay.
Yep.
All right. And do you have any 1s or 2s right now, or those are so rare?
I have no 1s and I have no 2s.
Wow. Okay.
So I only have 3s.
Wow.
Now, I'll give you an example of a 1. The last 1 I remember very briefly was Exxon. And Exxon actually violated my 1 stricture. For my 1, I want to believe that it has the possibility of being a 10-bagger over 10 years, over 5 years, I'm sorry. And I didn't see Exxon having that. But by every other attribute, it was so cheap, briefly, that it was a 1. The 1 before that was Ivanhoe. And let me give you the statistics around Ivanhoe. The largest and highest grade undeveloped copper deposit on the planet. At Kakula, a 6% average mine grade in a world where the median mine grade worldwide was 1/2 of 1%.
Wow.
63-cent share price with 97 cents a share cash in the treasury. And where the major investor, NexGen Mining, a very, very, very experienced investor, had just invested at $1.13 per share. I believed that the company was selling at a greater than 50% discount to the realizable liquidation value of the company. I believed that their 2 redundant assets, including the Platte Reef, which didn't figure in the valuation, were worth more than the market cap. Platte Reef having a 10% owner, JOCMEC, the government of Japan, who had paid $200 million for their 10%, meaning that the deposit itself could be valued at $2 billion against a market capitalization for the whole company of less than $300 million.
Wow.
So I saw a circumstance where, I thought that the company was selling for less than half of liquidation value. I saw a catalyst in place that could and should double the share price within 18 months. And I thought that the company was a reasonable bet to increase tenfold over 5 years. I was wrong, of course. The company went from 63 cents to $13, more than a tenfold increase. But that's a pretty rough set of circumstances. I also understood the risks. The risks were Congo. It was fairly obvious to me that the risk on 63 cents was 63 cents, although they had 93 cents or 93 or 96 cents a share cash in the company. There was systemic risk. So I need to understand why the stock is cheap. If I don't understand why the stock is cheap, I don't understand my risk. Those are pretty demanding criterion.
Yeah, that's why you average one of those every 3 years. Was the Exxon hot minute? Was that the COVID crash when oil went negative?
Well, two things happened with Exxon. There was the COVID crash when the oil price briefly went sub-zero. That was stupid.
That was awesome.
At the same time, Exxon was kicked out of the Dow 30. And so all of the index funds had to sell the stock. That was obviously a one-off event. They didn't have to sell it again because they didn't have it anymore. So all of the index funds had to sell the stock and nobody had to buy it.
Okay. Wow. Yeah, that oil going negative, that was the best bet of my life.
Yep.
Okay, we got a lot of questions on, haven't had this one before, coal. Probably the most submitted on coal. So maybe you could just kind of give us we had Doomberg on the show a couple days ago, and he was saying that every year progressively, we as a planet are just burning more coal, despite what our big thinkers want to limit that. Maybe give us just a 60-second macro on coal.
Well, I think that's the most important part. Despite the wishes of the big thinkers and the pronouncements of Ms. Thornburg, the greatest year in human history with regards to coal demand was 2022. Now that it's October of 2023, we've already eclipsed this year. There are coal plants being built around the world, including, ironically, the opening of a new coal mine in Germany that's being accomplished with the tearing down of a wind farm.
Wow.
I mentioned that not because it's economically important statistically, but merely because it's funny.
Yeah.
Steve, it's important to understand that there are 1 billion poor people on Earth with no access to electricity. It's important to understand that there are 2 billion people on Earth that have access to intermittent or unaffordable electricity. And the idea that we are going to deny them access to the same lifestyle opportunities that we face as a consequence of a carbon budget that we contributed. Those poor people didn't put the carbon in the atmosphere 30 years ago. We did. And while they are probably interested in our feelings, they aren't as interested in our feelings as they are in acquiring electricity. The second fact that your viewers need to understand considering coal is that we have now invested almost $5 trillion in alternative energies. And we've reduced the market share of fossil fuel over 40 years from a high of 82% all the way down to 81%.
Wow.
So while there's a wonderful narrative, which I agree with, we shouldn't be pumping more crap into the air. We shouldn't be pumping more crap in the water. Until technology, in particular nuclear technology, allows us to generate sufficient cheap baseload power in a non-carbon generating fashion, we are going to generate carbon because there's 3 billion people who don't live like us who want to and are going to. The alternative of that is that the lifestyle that we enjoy is going to be really materially negatively affected in a way that North American, Western consumers and voters will have no part of. They want the green narrative until it results in higher heating bills and higher gasoline prices and an unavailability of the lifestyle to which they've become accustomed. It's important that we get past expectations based on narrative and get back to expectations based on economics and arithmetic.
Yeah, it's not fair to expect them to come up all of a sudden and their first source of power is a nuclear power plant instead of coming from the ground up like is possible. Um,
Unless North American consumers want to pay 50 cents a kilowatt hour for electricity and $20 a gallon for gasoline. I mean, we can do it. You first, of course.
yeah, exactly. So you buy us that that power plant. Okay, so Ivania, Bjorn, Penn State. A lot of guys are asking about coal. Which coal stocks below a $5 billion market cap would Rick consider the best to own over a long period of time for dividends and capital appreciation?
I don't own any of the small cap coals. I want to own the large, low cost producers who are stout enough that they can defend themselves against the prevailing political winds. The truth is that the best coal producers in the world aren't coal producers. They're multi-commodity producers. The finest is probably Glencore, which comes with political and social risk. I am not as interested in the capital gains around pure coal producers as I am the ability of multi-commodity producers to utilize the current cash flows that they're getting from their coal operations in intelligent recycle to produce 2 or 3 decade-long income streams for me. I think differently. One of the problems, Steve, with making recommendations is that the people who ask for recommendations assume that there's one-size-fits-all responses. And the response that I give you is very much the response of a rich 70-year-old guy who has a very different perspective than the person asking the question.
Okay, yeah, like Glencore, they do recycling. They pull a lot of other stuff out of the ground other than coal. That's just.
And they have a wonderful track record for taking free cash flow from this operation and recycling it into a new operation. They've done a great job in the coal business, by the way. They bought, I believe it was 2/3 of an operation that they operated from their partners in the height of the coal furor. They bought a 35-year reserve for 1.5 times free cash flow.
Wow. Wow, what a deal.
And given their track record for the positive recycling of cash into new operations, they'll compound that benefit.
Yeah. Why do they have 2 separate tickers? Like one is exactly twice the amount of the other. One's 1 share, the other one's 2. Do you know why they do
I'm
that?
embarrassed to say I don't know. It's probably the difference between the primary share and the ADR, but I don't know.
Okay. Okay. All right. Well, we can nix a lot of these because these are all below 5 billion. Okay. Moving on to oil. We've already hit a little bit on Exxon. Dubs wants to know, why do you prefer Exxon over Chevron? So why do you prefer Exxon over Chevron?
Well, let's get one straight. I own them both. I prefer Exxon because they have a longer term track record of the successful redeployment of capital, and because they have made a series of absolutely massive discoveries in Guyana. They have access to 11 billion barrels upstream, which will course through them. It may be that tomorrow Chevron will make a similar discovery somewhere else, but they haven't made it yet. And so I prefer Exxon to Chevron. Chevron is cheaper on most metrics than Exxon. And so for certain buyers, Chevron might be more suitable. What I am looking for is durability and sustainability and a corporate culture around the successful redeployment of capital in all circumstances. I'm attracted to the fact that Exxon is continuing to make sustaining capital investments while generating enough cash to reward the shareholders handsomely. I'm attracted too to their acquisition yesterday of Pioneer.
Yeah, I was going to ask you about that.
$60 billion acquisition. If I'm wrong about the direction of oil prices, this is a disaster. If I'm right about the direction of oil prices, this is one of the great acquisitions in human history. It's important to note that the Pioneer acquisition makes Exxon, in effect, the dominant player in the Permian in the United States. That's important because drilling locations in the Permian pay out fairly quickly, which means that Exxon can make capital allocations during periods of high oil prices and in fact time their production to the market, something that they can't do. As an example, in offshore Guyana, where you invest $10 billion and then produce it out over 20 years. The ability to time the production in the Permian Basin and the ability to access the best petroleum production, processing, and distribution infrastructure in the world is important.
Okay, excellent. All right. User wants to know, interested in what Rick thinks about oil royalty stocks.
I love them. I've been an investor in the oil royalty space for a very long time. An argument can be made that natural resource investors could construct their entire energy and mining portfolio out of royalty and streaming stocks. And while ironically they wouldn't do as well in raging bull markets, they would do better over the course of a decade, I suspect, than more broadly constructed portfolios. Ironically, they wouldn't do as well during raging bull markets because their margins are so high, their costs are so low that the increase in commodity prices wouldn't impact them positively as aggressively as it would for marginal producers. In other words, they're too good a business in a raging bull market. A less good business has more margin expansion in a bull market. But I'm of the age now, Steve, where you can take away some of my upside if you take away most of my downside. And that's what royalty and streaming does, including oil and gas royalty and streaming. If you are putting together a portfolio of oil and gas royalty companies, don't forget the Canadian companies. There's fine companies in the United States, but there's a couple of fine ones in Canada too.
Okay. And Esprin asks about Prairie Sky.
Prairie Sky is one of those, a Canadian domiciled royalty company, albeit with a fairly large U.S. royalty portfolio too. A fairly sleepy company. It's done very well over 5 years, not so well over the last year. Occasional concerns about capital allocation efficiency, but a company with an absolutely unassailable royalty portfolio in terms of quality.
Okay. What ranking would you give them?
I have them as a 4 currently.
Okay. He also wants to know about CTO royalty. I haven't heard of them.
I don't know enough about CTO to comment.
CTO.
I know them, but I haven't analyzed them as deeply as I have some others.
Okay. And Blackstone Minerals.
Blackstone I have as a 4.
We like that one a lot.
And I own
their
it.
dividends are pretty pretty impressive.
Yep.
Okay. Sab. What does Rick think of partially state-owned oil companies like Petrobras and Sociedad Animonia, which are trading at very low PE ratios? Is the political risk fairly priced in, or does the market overreact to it?
He should add Ecopetrol to that. I own them. I own them knowing that I'm being unpatriotic, which is to say I'm subsidizing the enemy. I own them also knowing about the level of political risk. I think in the case of Ecopetrol and Petrobras, that the potential reward justifies the risk. It is absolutely true that the economic decisions made by partially state-owned oil companies are driven by the whims and the needs of the politicians. So as an example, Petrobras has frequently had to underinvest in maintaining productive capacity in Brazil because of the need of the Brazilian state for unaffordable dividends. Of course, being a shareholder there, they had to pass on some of that unaffordable dividend to me, which took away some of the bite. And the questioner's concern is very well put. In the case of both Petrobras and Ecopetrol, in the last 2 years, they got so stupidly cheap, they're less cheap now, that I had to hold my nose and buy them and become a partner of my enemy.
Okay. What numbers would you give them?
In both cases now, I have them as 5s.
Fairly priced.
Based on my acquisition cost, they'd be called 4s.
All right. Jeffrey Swainer, he wants to thank you for introducing him to uranium, so another beneficiary of your knowledge. He's curious about African oil.
I own Africa Oil. Africa Oil is only suitable for a very risk-tolerant investor. Keith Hill, who is the reason I invested, well, I wrote the founding check for Africa Oil many decades ago. I did that because of Keith Hill. Keith Hill retires this year, which adds a new element of risk. The steward of my capital and the Lundin family capital in Africa Oil is retiring, which is risky. The other risk, which is to say around the Kenyan assets, they dealt with by relinquishing the Kenyan assets to their partners, having extracted $200-something million out of them. And the company now is built around some superb producing assets in Nigeria. Nigeria, of course, represents political risk, but also represents substantial financial and exploration upside. In addition to that, the company is exposed indirectly in at least three potentially world-class discoveries in Namibia, South Africa, and Guyana, respectively. So for risk-oriented investors, specifically for people who could stomach financially and psychologically a risk which would cost them 50% of that portion of their portfolio, in hopes of a 300 or 400% gain, Africa Oil is attractive. For me, it's attractive.
Okay, high risk. What number would you give it?
I have Africa Oil as a 4.
Okay. All right. Ricardo, offshore oil services in general, companies like Transocean or Valaris.
I have proven myself to be an ineffective analyst in the oil services space. I've tried for many years. The oil services business and the provision of innovative services at competitive costs is not an area of securities analysis that I have developed a competitive edge in. And so I would prefer not to cause people to run the risk of my recommendations in those sectors. I own Halliburton, I own Schlumberger, and I own them because over time they've been such great basic businesses that I'm able to overlook my lack of expertise, but I don't want to make any recommendations or comments in the sector.
Okay, that's like me with poker. I'm very profitable at Texas Hold'em, not so much at Omaha. That one I pay. Okay, moving on to uranium. Courtney wants to know, I started investing in uranium a couple years ago, but am focused on the beta plays for now as I'm busy running my businesses. She has a life. However, I want to dedicate more time to understanding the nuances of the producers, miners, and the whole uranium ecosystem. Is there a book you can recommend that kind of can serve as a uranium 101? Thank you. Love your content. I've learned a lot.
I would ask her to buy access to the Uranium Bootcamp. It's only $99. There are no books that I'm aware of that will give people sufficient background in uranium. I would also not discourage the lady from sticking with the beta. The idea that you have to optimize an outcome in a market that has as much upside left as in uranium, it may be that the lady is better off spending the time and treasure that she would use becoming a uranium expert and working on her own business. There is something to be said for constructing a uranium portfolio even today around the Sprott Physical Uranium Trust, the North Shore Uranium ETF, admittedly inefficient with regards to alpha, and Cameco, and calling it a day. Sometimes making good money with lower effort and lower risk and saving your time for your own business is better than investing time and treasure and risk trying to make great as opposed to good money.
Yeah. Okay. Keep the beta. Okay. I get this question a lot. This one happened to be from Harley Davidson. Missed out on the uranium blow up. When is a good time to get in?
Now.
The
The best time was 2.5 years ago. Like they say about planting a tree, the best time is 30 years ago. Second best time is right now. The uranium spot price has done well what will determine the future of uranium is the uranium term market. And I think the term market is going to firm a lot because of construction of new reactors and the need to secure fuel for them to amortize the loans associated with the capital costs of the reactors. But this isn't a circumstance that takes place in the future. It's a circumstance that takes place as a consequence of the tightening of uranium, both around the pace of Japanese restarts and the taking of 55 million pounds of uranium out of the market by the spot physical uranium trust. That means that the future in uranium is right now.
Yeah.
Okay. The game is underway for a year. The game has, I would suspect, at least 2 years to go.
Oh, okay. That's good news. Okay, last time you were on, we were talking about is it time to kind of start rolling out of the majors and maybe start playing a little more alpha? You were on Liberty and Finance with Dunnigan recently, and you kind of alluded to that, like you know, we might be entering the point of the cycle now where you know, the majors have had a little bit of a run here. And when I plot this on the chart, I can pull it up if you want, comparing the Sprott Physical Uranium Trust to funds like URNJ. URNJ is starting to outperform the metal now, where for a long time that wasn't the case. The metal was outperforming the stocks. Nolan wants to know, could you revisit your buy on URNJ? It's run up over 100%.
That's really a function of your tolerance for risk. I would suggest that the easy money in URNJ has been made. That sector went from no bid to having a bid, which means it doubled. If I didn't know the person asking the question well, and they were already a holder of URNJ, my suggestion might be to sell half and get the rest for free. If, however, the questioner is willing to do the work and accept the risk, I think that there's a lot of room left if you're willing to accept the risk.
Okay.
I have more cash in my own portfolios than I need right now. As a younger person, when I had a speculative thesis that proved true, and I got 100% gain in a year, I very often sold enough of the position to pay for the position and pay the tax associated with the capital gains, and held the rest of the position in what I called the point of no concern. Later, I learned that my failure to keep larger pieces of a theme that I thought was intact cost me more money than it saved. Now, that had to do with the fact that as I matured, my opportunity cost associated with the reinvestment of those proceeds was less. And I realized that that strategy is probably more important than it is to me than it is to a younger investor who is willing to work hard and take risk.
Okay. We did that point of no concern with Global Atomic when it had had the coup, and now we have it for free.
Aren't you happy about that?
Yeah, it's pretty cool. It's like, got your original buy-in back, and now you're on the house money. Okay. Oh, well, that kind of runs in well with this one. Frank, what is Rick's opinion on the situation in Niger regarding Global Atomic, their financing from Western banks, and the role of the U.S. military drone base 201 in the country?
I suspect that the U.S. will be allowed to keep the bank, keep the base. I think in Niger, the excesses of the French colonial infrastructure were much more personally felt by the citizens of Niger than the U.S. presence. And I think that the security guarantees made by the new government of Niger with regards to the jihadists can only be kept with access to American drone-based intelligence. I think, too, that the primary target of economic retribution in Niger will be felt by the French state and the French uranium apparatus. I don't believe that Niger has access to the capital or expertise, nor do I believe that they have the desire to nationalize the uranium industry. I believe what will happen is that Western countries will face much more severe competition from financial interests in the Middle East, which is to say Saudi or UAE, based financial institutions, Russian financial institutions as a consequence of the security guarantees of Wagner, and Chinese institutions. My belief is that the first mover advantage enjoyed by GOVX and General Atomic are likely over time to be respected. What is going to happen is that the net present values are going to be lower because the discounts will have to be amortized over a long time. You're going to have political reconciliation in Niger in order for the financial and political accords to be established, which will allow for the third-party funding of those deposits. And that isn't going to occur anytime soon.
Okay. They have a weight on them.
Sorry for that long-winded answer, but that was a nuanced question.
Yeah. We watched an interview by the CEO of his name's escaping me right now, of Global Atomic, but he was saying it's pretty tough to get parts. Even stuff like drill bits, and it's just it's not moving as quick as they had hoped.
And certainly, obtaining multilateral financing, private sector financing, in a country where the fiscal accords haven't been worked out yet. In other words, you don't know what the state's going to take. That's difficult. Lenders have this inconvenient habit of wanting to be paid back.
Yeah. All right. Stella wants to know about NewScale, the SMR company.
Don't know enough to comment.
Okay.
I regard myself as a resource guy, not a technology guy. I'm trying to learn more about NewScale so that I learn more about the prospective demands for uranium around SMRs.
Yeah.
But I wouldn't consider myself as having information concerning NewScale that was worth imparting.
Okay. All right. And fission uranium.
I like fission. I like the whole western side of the Athabasca Basin. Those are very high-grade deposits. They're deposits that haven't had much money spent on them in the last 5 or 6 years in exploration, which means they're deposits that are going to grow. NexGen is probably the best undeveloped uranium deposit in the world. It's fission's neighbor. And whoever builds that deposit better build them simultaneously. The idea that you construct 300 miles worth of infrastructure twice is idiotic. Now, it happened in Northern Canada, the diamond business. BHP and RTZ had so much enmity towards each other that they built duplicate infrastructure 25 kilometers away at a combined cost to their shareholders of over $500 million. I'm hoping that Fission and NexGen don't do the same. My suspicion is that ultimately both of them are taken over by some larger suitor, and that it gets built. Fission is a wonderful deposit. It should not be a standalone deposit. It should be icing on the cake for whoever builds NexGen.
Okay. What number would you give Fission and NexGen?
I have Fission and NexGen at 4. If they hadn't had such dramatic run-ups, I'd have them as 3s.
Okay. Yeah, they've had a nice run up in the last few months.
Spectacular run-ups.
Yeah. Thank you to your uranium boot camp. Okay, Boss Energy.
We are in the high risk, high reward phase. You're building. Do we have on time, on budget, nameplate capacity? I think we will. We've had a magnificent run up in that stock. I own a boatload of it. I own way more than I ought to because of my familiarity with the deposit and my closeness with the CEO, who I have huge respect for. I'm violating my own rules here and betting on time, on budget, nameplate completion, and the fact that a bunch of this output is thus far uncommitted. I think it gets committed at a very high price. And I think Boss actually ultimately gets taken over. I don't think the current management team wants it to get taken over. I think they want to build a large uranium producer out of recycling the cash flow from Boss. But I suspect that the cost of capital for a larger producer will be such that ultimately the Boss guys get subsumed into somebody larger.
Okay. And what number would you give Boss?
I have Boss as a 4.
Okay.
I have very few 3s.
Yeah. Okay. Platinum Palladium. RMF wants to know, hi there, I've invested in Sprott and Aberdeen to buy platinum. but I cannot find a good platinum miner that isn't in South Africa or Russia. What does Rick think of Chalice mining?
Chalice is a nice deposit. I think of it more as a nickel deposit than a platinum palladium deposit. I'm okay with that. Chalice is getting clobbered in price, and to the extent that it continues to get clobbered, I'll like it. Now, make no mistake, they're a developer. You aren't buying a platinum and palladium producer. You are speculating on time, on budget, nameplate capacity. That's not the same as investing. I am, as a consequence of an old movie, a Chalice shareholder. I have long since passed the point of no concern with regards to Chalice, which I in fact exercised. The speculative stock that I'm a big owner of is Centaurus, which is a newer discovery in Brazil. It's a long way thus far from being a tier one discovery, but I think it has a chance of being a tier one discovery. The market cap is constrained partially by virtue of the fact that it's in Brazil. So if I had a choice for a speculator around the nickel, platinum, and palladium play, my pick would be Centaurus.
Okay. Cry Willie wants to know. Please ask him what the current status of South African miners is. Are they still in trouble? I'm holding a heavy Impala platinum bag.
Yeah, there's a lot of risk in South Africa. The current government, while it has some good elements, I think could best be described as political and kleptocratic. There are problems in South Africa with governance. There are problems in South Africa with state-supported crime. There are problems in South Africa with transportation. Transnet, the national rail system, is bankrupt. There are problems in South Africa with access to power. And there are problems in South Africa with regards to political strictures, which means that the companies are unwilling to make capital investments to lower their labor costs because they're afraid they won't open the mines. The consequence of that is that they have to hire unskilled labor at wage rates that aren't livable. The mine workers need to be paid more, but they can't be paid more because they don't employ enough capital to make the mine economic. A very, very, very difficult circumstance.
But kind of a good one if you're holding the physical platinum, right?
Or if you have access to platinum and palladium assets outside of the United States and Russia. I was a very large shareholder in Norilsk. I didn't understand that societies could be as stupid as the United States, the Ukraine, and Russia. And the consequence of that is that I got punished for my genius.
All right. Let's see. We're getting low. Okay. You ready to enter the lightning round?
Sure.
Okay. Here we go. Esperan wants to know Equinox Gold.
Equinox Gold, I may upgrade to a 3. It has been punished because people don't believe that they will enjoy an on-time, on-budget nameplate capacity finish at Greenstone. I think they will. The financing risk has passed them because they did the financing. If I'm correct and they achieve nameplate capacity in the second quarter of 2024, I think the stock doubles without a move in the gold price.
Okay. Jeffrey Spalding, Adriatic Metals.
I love Adriatic. I absolutely love Adriatic. Again, you have a completion risk. You are building a silver, lead, zinc mine, silver dominant. You are building it in a jurisdiction that doesn't have a lot of modern mining history, so there's some political risk. But the deposit is spectacular. If you achieve on time, on budget, nameplate capacity, particularly if you get any kind of silver market at all, which I think we will get at some point in time, I think this is a real home run. But it's only a home run for investors who can tolerate both volatility and risk. You're building a mine and you're having explorationists build a mine, which is risky. You're building it in a jurisdiction where there isn't much modern history and probably no legal precedent with regards to mining. So there's plenty of risk.
Bosnia. Okay. Origin Royalties.
This is one of the very few microcap companies that I think is a no-brainer. 110 million market cap, well cashed up, enjoying great free cash flow from the Ermitaño silver mine operated by First Majestic. Nice exploration upside there, and First Majestic is in fact actively exploring it. At the same time that you have an undeveloped royalty at Silica Cap operated by Anglo Gold in Nevada. I suspect that either of these royalties are worth the market cap of Origin. Note that the company is extremely closely held. 9 shareholders, including myself, control more than 60% of the company.
Wow.
So if you're going to try and come into the stock, use a good till cancel limit order. Be very, very, very patient.
Okay. All right. A 3?
Not a 3, because
4.
it's so illiquid, a 4.
Okay.
If you could sell it,
Yeah.
if you could buy it or sell it, it would be a 3. It's extremely well run. These guys toss around nickels as though they were manhole covers. The future cash flows are extraordinarily visible, and they can grow with exploration. It's highly illiquid.
Okay. Osisko Gold Royalties.
Osisko Gold Royalty, I have as a 4 on a valuation basis. I'm troubled with the fact that the CEO was thanked and excused. Osisko Gold Royalty, among other things, holds the control position in the other Osisko companies. My preference would be that those shares be treated as a source of liquidity rather than a control position, and the proceeds, rather than having it as a holding company, would be redeployed back into royalties. On a valuation basis, this company's cheap. The royalties, in particular the Malarctic and the Eleanor royalties, are top quality royalties. It is, on a sum of the parts basis, the cheapest of the big royalty companies.
Okay. Ridgeline Minerals.
I own it. Ridgeline is a company for people who are interested in grassroots speculation, prospect generation, and process. This is probably not suitable for investors who don't have some familiarity with exploration geology and exploration arithmetic. For those of you who do, I think this is a wonderful speculation.
Okay. Arizona Metals.
Arizona Metals, I'm doing some work on. I have to say, I'm afraid of Arizona. I'm afraid of the politics in Arizona. I'm afraid of a permitting regimen where, in particular, Resolution, a billion-ton deposit at 1.5% copper, one of the greatest copper deposits in the world, has been in permitting for 25 years. I'm attracted to the quality of deposits, the unique grade of the laramide terrain. I'm attracted to the fact that there's almost no deposit in Arizona that you can't see from a highway. I'm attracted to the fact that there is a wonderful community of miners in Arizona. So you have some of the highest quality labor in the world. You have power, you have water. Unfortunately, too many people from California moved there. And that's what scares me. I'm nervous too about the fact that the mining community in Arizona didn't engage with the indigenous communities before they engaged in the political process. The mining companies in Arizona, without exception, engaged politically with the state before they engaged with the indigenous people. Had the mining companies in Arizona followed the lead of some of their Canadian counterparts in northern BC and identified with the Navajo, identified with the Apache, shared some of the benefits with those people on a pre-active basis, and then allowed those native people to carry the political torch, those mines would be in production. But it's too late now. The horse is out of the barn.
Yeah, they showed their hand.
I am really, really attracted to the geology of Arizona. It hasn't been explored by modern methods really, since San Manuel and deposits like that, and the success that Arizona Sonora, Arizona Metals, Robert Friedland, among others, are enjoying in Arizona. points to a continuing and amazing endowment in the laramide terrain under Arizona.
Okay, wrapping up, two juniors, Guanajuato Silver and Dolly Varden.
I got everything I wanted out of Dolly Varden. I was a fairly large Dolly Varden shareholder. That isn't to say that the game is over. I looked at their acquisition of their uphill neighbor, and the fact that what had been a 30 million ounce deposit was becoming a conjoined 100 million ounce deposit. Made a big bet that exploration would work. It did work. I've been paid back. I have a huge degree of respect for the guy. He just gave me too much too quick. Guanajuato, I'm not a shareholder of. There isn't enough data to interest me currently in Guanajuato Silver, although the fact that the silver industry is totally unloved, the fact that investors are sick to death of silver, the fact that silver is hated means that I'll be looking to add more silver names in Guanajuato or revisiting Dolly Varden if they give me an excuse, either through a falling share price or through more data. I mean, those are certainly both on the table.
Okay. All right. All right. Well, thank you, Rick, very much. I am looking forward to the Royalty and Streaming Boot Camp. It is October 21st. There will be a link down in the show notes. Any other things you want to close on?
Well, as usual, if people want to carry on a discussion about natural resource investing with me, I'd love them to do it. Go to my website, Rural Investment Media, list your natural resource stocks. I'll rank them 1 to 10, no obligation. And I'll comment on individual issues if I think my comments might have some value. I can be of more immediate use to you if you give me $99 and come to the Royalty and Streaming Boot Camp. If you don't feel I gave you your $99 worth, simply tell me and I'll give it back to you.
Awesome. Awesome. Yes. And your links for portfolio review are down in the show notes below. And so is your Rural Classroom. Rick, always a pleasure. Thank you again. You have a great rest of the day, sir.
Pleasure is mine, Steve. Thank you for making this opportunity available to me.